Thanks, Marty. Hello to everyone online and to everyone in the room. My name is Evan Chrapko. I'm the founder and CEO of Trust Science. I'm in a room and possibly online with a lot of people that have trust issues related to the fact that if you're high net worth or you're in the position of money, you have a lot of new best friends or long lost relatives that you didn't know you had and things like that. I discovered that for myself after I had a very large exit, and it turned into the origin story for Trust Science because I was burned by a business partner at the time which I didn't see coming. So I was very frustrated with myself, thinking I give out my trust too easily, and is there a technology way to get my gut out of the equation, being a technology serial entrepreneur. And so the company was started with the idea that it could be global, that it needed to scale. It could be global and at a high level, predicting what another human is going to do. So the science of trustworthiness is just a fancy way of saying we're going to predict human behavior. Now, that's also a really good way to ruin a good business. A good technology commercialization is to try and be all things to all people or boil the ocean. That never works. You have to get very narrow, build a global platform that has many options for exit, but go very, very narrowly in your go-to market, hyper narrowly laser focused. And so with Trust Science, we did credit worthiness. So what is a human being going to do when you give them money? Will they give it back to you with interest is the question that we're answering right now for banks and lenders. So my customers are lenders and consumer finance companies. It's extraordinarily great timing for me to be hitting the market now, this kind of market where the lenders are struggling with a lot of quality issues with the borrower base. So my background, just to summarize quickly, I grew up on a farm. We were raised with the ethos of leaving the world a better place. I got my JD just up the island here at Columbia. And in my career of commercializing technology, either disrupting old slow-moving categories or creating brand new ones, I've delivered realized gains to my investors, now approaching $1 billion. Trust Science is the biggest of my projects to date by far, and we're only just getting going, and we are now shifting into a higher gear. My wife tells me this will also be my last one, because when I do these things, I'm pretty 110% focused, all in. I'm here, and I'm everywhere. What I do is raise money. I'm doing it unconventionally from the market sense, or from the common way to do this is to approach an institutional investor. I don't have any institutional investors in Trust Science. That's not a never. We have raised double digits of millions of dollars. It's just to protect against the dilution of the supporters that I've had to date. I have the absolutely simplest cap table on the planet. A child in grade 5 or grade 6 will be able to figure out proceeds on exit because it's not complicated by a lot of different, a stack of legals 3 feet high. So the work that we're doing is that down market consumers, known as subprime, it's a rapidly growing group of people in the world. They are not scored properly by the conventional multi-billion-dollar players in the space, decades old names that you know, like FICO or Vantage, other players with the data that you know, Equifax, Experian, and TransUnion. What we call these wrongly scored subprime people is the invisible primes. It's approximately a 40% error factor. They are measured in the tens of millions in the US alone, hundreds of millions and billions, according to the World Bank globally. And thanks to both COVID, the pandemic, and that lockdown mess, as well as what's happening more recently with inflation and interest rates, the chaos in data and the ability to score people using decades old methods has gone out the window. And so we have a really, really big opportunity. It's also really impactful. The Real Leaders magazine put Trust Science in the top 200 of companies with impact last year. That was alongside of others in the technology category. Of those 200 companies, only 18 of us were technology companies. And so I was sitting alongside of the Microsofts and Teslas of the world. The solution for the techies in the audience, or if you're interested, it's marrying AI, very deep foundational capabilities in AI and a lot of innovation in how we're using that and creating it, as well as big data and alternative data. What I'm fond of saying, without, take this the right way, IADS, the acronym IADS, it's about the data, stupid. You hear a lot about AI this, AI that, AI. The data, if you're not feeding or training your AI models properly, you're not going to get anywhere. You'll have something very rapidly telling you a lot of garbage. So you have to marry both of these things properly. It's a non-trivial issue, a difficult problem to do in a space where the data is opaque. It's a highly valuable sector. Recently, in the last number of quarters or short number of years, you've had very sizable exits. I've summarized this in a chart that's a little messy. You can come up and we can discuss it in more detail. But roughly along the left-hand side, you see technology, new versus modern, or AI versus standard, old tech. And on the bottom, you have types of data. We put ourselves in that top right-hand quadrant, but you see some of the exits in the space measured in the 9 and 10 figures. We are in good company that way. My customers, jokingly, or if they were sitting in the room, I would say are boring. They're successfully lending money. They're making money. They're profitable and public. Some of them are private, but I have a mix of public and private customers in consumer finance and banking. In Canada, the Schedule I banks are part of the customer base, and they're growing. Since we came into market in 2019, my customer mass, as measured by their book of loans, customers and prospects, is exploding. And we are now engaged with, as prospects, the household names, banks that you would know. Their issue is that they're happily lending to high quality borrowers, but they can't expand their market down market if FICO is telling them it's subprime. By their mandate, they're not allowed. What we're able to show them is there are these invisible primes, people who would rather lose their left arm than welch on a debt. And it's a very big number, trillions of dollars of potential. Marty.
There's a quote from Mike Milken I heard the other day, and the quote is that he found countries are lousy borrowers, but that entrepreneurs and individuals are very good at borrowers.
Yeah, the quote on countries being lousy borrowers and individuals being better, it's apt if you can score them, if you can screen properly, because there are a lot of lousy individual borrowers too.
Absolutely.
So we're showing our customers the worthy borrowers.
Kind of like a Greenback model, isn't it?
Kind of like yes, exactly. The question in the audience, if you can't hear it online, was a reference to Grameen Bank. So the growth has been explosive. These are some of the other logos. We are taking even further narrowed approach on, for the moment, focusing on automobile lending and unsecured consumer finance. That just makes it us extraordinarily predictive in those markets. We will land here and expand as we go. We were named one of the top 5 fastest growing fintechs in all of the Western Hemisphere. Just recently, that press release went out a couple of weeks ago. That's 20 countries across all of the Americas. The Financial Times did that research. They started the research last year, put us through a whole bunch of due diligence, us and thousands of others. And they were working in conjunction with the German company Statista. Last year, so in Q4, the equivalent of the Wall Street Journal in Canada named us the 20th fastest growing company in Canada. That's all industries, all sectors considered. So we're now breaking out of orbit. Speaking of validation or due diligence, the TD Bank did an enormous amount of due diligence. more than I've experienced in some of my large M&A, before they allowed their global head of innovation to join my advisory board. We're very proud of that, and it's been a phenomenally insightful and valuable relationship and tons of doors being opened. Other facts or things to talk about is that we're extremely capital efficient, approaching now cash flow break even. I already mentioned that we have the simplest cap table on the planet. The subscription agreement is 1 page long. And I'm fanatical about security and privacy in this space, as you might want to know. I often get the question, are we tight or are we locked down on the security facet or vulnerability? And the answer is absolutely yes, or we wouldn't have a business very soon. It's a rich target, Marty.
How much have you raised and how much have you invested? And are you only looking at North America right now for these credit ratings, or how broad is the platform?
Yes, we've raised to date $20 million, just over 20 million. And the market that we're focused on is North America, the US primarily, also Canada. But the third bullet point here is that, sorry, that 30 million is a Canadian dollar number. The third bullet here is talking to us having a patent portfolio measured in the double digits, over 50 patents now across 13 countries. And we've used them successfully to shut down wannabe competitors or threats here in the US.
So you've got your company, you've got the intermediaries that you're working with, the banks and the private lenders, is that right? Both sides? And then you've got the subprime or invisible, whatever you want to call them, borrowers, okay? What is the ripple effect on either regulation pending, interest rates coming, or other kinds of issues, banking dislocation, that you're going to take advantage of?
The question is what's pending or looming with respect to the regulatory environment?
Or interest rates.
Or interest rates. My answer to that is the more chaos, the better for a legitimately AI-based platform. The reason is that I can take those inputs as they come near real time and learn. The model learns on that. My competitors, multi-billion-dollar Fortune 500s, though they may be, are flat-footed. They're based on infrastructure that is not designed to be responsive like that. And so it's part of the reason I'm getting frighteningly effective at being able to score and judge a loan application, as well as now we've expanded into actually being able to go out and find potential good borrowers and bring them back to my customer lenders. As well, a different aspect to your question, the regulatory environment. Just early this morning, one of the chief regulator in Canada of the financial institutions released a paper position on AI in the financial sector, and we were contributors to their research. We are being pulled in and we are proactively dealing with the regulators. We're not running away from them the way a lot of the freshly minted MBAs in Stanford go fast and break things. In the financial services sector, you break things, Evan goes to jail. So we're very, very aware of and attentive to and being proactive about the regulatory environment as well. Question in the back.
I'll ask you, what's your business model? How do your clients pay you?
Yeah, good question. The model was the question was, what is my business model? We are charging as you use us, so per file. When commercializing new technology, the last thing you want to do is try and teach your market a new way of doing business, because the market knows how to buy credit scores or leads for borrowers as a per file on a per file or per consumer basis. That's how I price ourselves. As a startup, though, I can be more creative with the pricing sheet. I'm not Oracle or Microsoft, take it or leave it. Here's my price list. We have done deals where they prepay a year's worth of usage, which helps me in not having to raise money, or other arrangements according to how they want to buy the technology. Some want to buy it as consulting, and so on. This man was first, and then we'll come back.
The AI plus alternative data is kind of an arcane concept. And my question is, what did you learn from the last meltdown? You had the failed scoring. What kind of data exactly are you looking for in these solutions? And because most data is very poor quality, it's noise. So
The-
it's the high quality data from noise data.
The question was what data are we using, and the answer in part lies in being tongue in cheek, but I'll narrow that. Any data and all data is good data to an AI system if it's properly on target and it deals with the issue at hand. And what I mean by that is when we talk to some of the multi-billion-dollar competitors and let them know that we are involving the consumer, for example, and letting them volunteer their data to us in full disclosure and getting the rights to say look in on their bank account. The big players don't understand that. They're not built in that model. They're built in a model where the lenders are all reporting on all of us. So many of you, if you've ever had a loan, you are now in TransUnion's database or Equifax or Experian because the fine print in that loan said that the lender is going to report on your repayment behavior every single month in what's called a Metro 2. That's now a decades old concept. And it's fine as far as it goes, and it's fine if you're focused on lending to the prime or super prime people in this room. That is not fine if you're trying to lend to a number of the people down on street level here. And so involving consumers through their devices giving us data is one example of the answer to your question. There are other data sources, though, in the world that are not being tapped by the conventional scoring agencies or lead generators that we are tapping, and we're only capable of tapping thanks to the power of the artificial intelligence or machine learning ops platform that we've built.
And the invisible prime is under 700, under 600?
Invisible prime, the question is, what's that definition? Different lenders put that cutoff at different places. Some say 700, some say 680, 640. So it's in that range. Then there's near prime and so on. You had a question here at the front.
One quick question. Is this a white label product or is it its own bureau?
Is the question is this a white label product or its own bureau? We're a standalone bureau. We're a registered what's technically known as a consumer reporting agency. That's federal in the US and province by province in Canada, legally registered as such. Question.
Yeah, I'm kind of interested if you can get outcomes data, meaning can you find out that because a lender was using your AI powered system, he's getting better results in his loan portfolio because they're not defaulting because you're better than your competitor XYZ? And one, do you have that data? Two, can you share that data so that you're able to build your company faster, better? Because you can go to your next prospect and say, I'm better, and you're going to save billions in money because you use me.
Yes, thank you. The question is, can we prove what we do? I think I'm paraphrasing. The answer is yes. This is a 100% data science type of exercise. Our lender customers are pretty sophisticated in that regard. And say, for example, if Equifax was coming to win their business and they were offering a different model, let's say a different type of score, it's a really well understood methodology is how you would compare that to the status quo. They call it a retroactive score study.
Yes.
And we engage in those all the time. And so we can show you in cold black and white math the superiority. The other thing that happens,
10%, 1%.
it depends on how sophisticated the lender is that we come to. Each of them we find at a different level of capability. And so that delta will depend on where they all are.
Give me a range.
It's ranged as high as ROIs of 201x. It's ranged if their measure is, some of them are more sensitive to, can you reduce my defaults?
Yeah.
So in that case, we're improving on that metric by 55%. And so on. There's a raft of different measures. It's how we've gotten the hockey stick growth. I think you may have missed that chart. I showed it earlier. We were named one of the top 4 fastest growing fintech in all of the Americas just 3 weeks ago.
Thank you.
And I'll hit my team here. I'll give you the team slide that's been up on the screen here. People who absolutely know what they're doing, very fast moving, extraordinarily deep and capable in technology commercialization. Some of my investors, high net worth individuals and family offices. David was the CFO who led the IPO of Facebook. He is now founder and CEO of multiple unicorn. Mike, whose face is blocked out, he is known as the unicorn whisperer in Seattle, very private guy, respect his privacy. However, he will talk to anyone who's contemplating making an investment in Trust Science. He quintupled down on his investment after watching us in action. He put his money first in 3 years ago and then came in much larger again here recently. Don in bottom left corner is the former CEO of $1 trillion of assets under management. Manulife is the parent company of John Hancock. And insurance underwriting, by the way, will be my next vertical. So after we've landed and stuck our landing in credit underwriting, and it's insurance underwriting is a different kind of underwriting and a different kind of assessing what a human being is going to do after you underwrite them. Don is pretty excited to take us around the world.
A minute.
I'm raising 6 and 7 figures. It's an extraordinarily simple process. At the last IvyFON event, someone came up to me and money was wired. Later that day, a one-page subscription agreement was exchanged. It can be that simple. I'm happy to go through a year's worth of due diligence if you need it. But I'm raising for a company that's already running. And in conventional terms, if we were institutionally backed, you might call us somewhere between Series A and Series B, although those definitions are not
It's like some sort of growth capital.
growth capital.
Could you give us a guide on your revenues and your valuation?
Yes. The previous slide showed that we're at 7 figures of revenue now, heading toward double digits. The cash flow break even is within now measured in months or a short number of quarters. And the valuation is at 37 million.
And what are you offering? Just plain stock?
Correct.
You can talk about that offline. There'll be a dinner. Any closing remarks?
Just that the patent portfolio is has been its own weapon. My use of funds is largely for marketing and go-to-market sales. The technology risk has been eliminated. This works in some of the most difficult environments that you can imagine for making these kinds of decisions. And there are other moats or barriers, including the regulatory hurdle that we have had to meet, non-trivial. And my contact information is here. I'll be around, including at dinner. Thanks, Marty, and thank you for everyone online who is watching remotely.
How big is the subprime market? Just in terms of like
Yeah, defining how big the subprime market is hard, but the numbers are measured in either hundreds of billions or starts with the T